guys, it's Chad Larson with MLD Wealth Money Matters. This is October. Again, always apologizing into the kind of the first. I always intend to get this out in the front part of the month. I was traveling briefly, and it always takes me kind of a couple days to get my thoughts out, let the month wind up, and see where we at. I just actually finished a really unique meeting with a great client. He just happened to be popping into the office and kind of asked me what my thoughts were. And I felt stumped for a second, more so because I didn't have anything new to say. We've been consistent and thematic about for the past number of months as I review the other podcasts and commentary that we communicate with our clients about what we see in front of us. And I don't think people want, it's a right way to frame this. And I'm not paid to be spastic and to run around and chase things. As an economist by training, we have to have a view of the market, understanding of the economy, take a look at the stock of what the depth and breadth of the market is doing, and then allocate capital and stay convicted. Obviously, we're always weighing different variables, secular trends, seasonal trends, earnings cycles, monetary policy, fiscal policy. I guess my short rant is to say this job isn't easy, but here we go. What happened in September? In September, the global markets were dominated by the U.S. Federal Reserve's decision to cut interest rates by 50 basis points. This is the first cut since 2020. This move brought the federal fund rate range to 4.75 to 5. This a significant step aimed at recalibrating monetary policy amid stable inflation and a very resilient labor market. Everyone's talking about job numbers, and we hinge off of looking at what the book's going to say every time job numbers come out, of keying into when that Fed's going to cut, because we've been in this higher for longer scenario. But the rate cut was part of a broader trend, with central banks globally easing rates, marking the most substantial collective effort since the pandemic began. The Fed's decision helped lift equity markets, with throughout September, the S&P 500 achieving its first positive performance in September since 2019. If you remember last month, the thematic was that September is the ugliest month of the year, and we had a good September. So reaching record highs. So again, we're going to talk about these inflection points. About the only commentaries I get is, we've had a number of liquidity events happen across our book of business, and then the clients that we manage have had a number of exits from private equity and private credit transactions, and a number of structured transactions that have come to put us in an enviable position to have a very high amount of liquidity, and by design. But investor optimism surged as a likelihood of a soft landing for the U.S. economy. It's been this tug of war between soft landing or recession, but avoiding a recession while maintaining low inflation. That probability rose up to 65% from 50 earlier in the year. So this translated into a strong year-to-date performance of major indices. The S&P is up significantly, and the NASDAQ is doing great. The Dow's trailing, and we're going to talk about that. It's more of a value-tilted old world economy business. But, on the bond front, and I teased last month, only nerds like to talk about bonds, but the reaction was a little more cautious. Long-term bond yields remained elevated, with the 10-year yield, Treasury yield aligning with forecasts of around 3.75, and an analyst warning that inflation risks like rising U.S. debt and adjustments to a neutral rate could limit further price gains in stocks, so even as the Fed continues to ease. So I think a lot of people are wondering, saying, "Hey, it's been a good run. Market seems expensive. Should we be sellers here?" It's been very good. Commodity markets, including oil, saw a lot of fluctuations. September was, partially very ugly for oil due to broader concerns about global growth, contributing to a volatile trading environment across a lot of asset classes. Gold at record highs. Been constructive on gold for quite some time. Bullion it's been a great place to be. Starting to pick away and come off of the bullion trade and selectively position across gold names, because as that bucket moves from bullion into the equities, we could see a gold market really develop here if gold prices stay where they're at. But we're already 8 days into October. Who knows, by the time this publishes and clears compliance, it's probably another few days. But oil prices have rallied into the front part of this month with increasing conflict throughout the Middle East. But some of the things I kind of wanted to talk about today, and I've got a number of charts up in front of me. And again, if anyone wants access to them, just please reach out to me, and a member of my myself or a member of my team is happy to circulate. But the S&P 500, where is it at? And again, I'll wrap this whole conversation up about why I continue to drive home about the S&P. But it's a bit of an inflection point. So currently, as of September 30th, the forward price to earnings ratio of the S&P 500 is 21 and a half times. Um, is that expensive? The last peak we saw was January 3rd, 2022, when the market peaked before having a trough, and the market was 21.4. It peaked in 19 at 19.2 times. It peaked in October 9th of 2007. The market was at 15 times. The tech bubble had a 25 times earnings bubble, but the markets have been on tilt since a low of October 12th, 2022. When the market bottomed out last time, the markets are up 61% since 2022. But where do we go from here? Dividend yield is sitting around 1.4%, pretty in line with what we've seen since 2000. It got as high as 1.9, but it's on average been around that 1.5. The 10-year treasury yield is higher than we've seen over the last number of years. But going back to 2000, when we had the tech crash, the 10-year treasury was even more elevated at 6.2 times. So, here we are. But is a market high a bad thing? If you can stick around through my tirade of ranting, I'll tell you why it's not at the end. Next, kind of wanted to talk about was really what the sources of earnings growth and profit margins have been. What on average, there's three things that contribute to earnings per share, and that's margin, revenue, and share count. And so, on the average between 2001 and 2023, total earnings per share growth we've seen on average about 7.5% per annum. In 2024, we saw earnings per share growth thus far at 9.4%. We're seeing strong growth. That's coming from margin. Companies are very profitable now. A lot of scale to technology. The makeup of the index is very different than it was in the early 2000s. So 8.7% has come from of the 9.4 has come from margin. We've seen 1.5% revenue growth. So revenue growth remains a little bit muted, but interest rates have remained pretty high if you put that in. And share count has detracted, so it's taken off 0.7 because there has been some new issuance, and so more shares would have been more dilutive against earnings. So all in all, very healthy from my view. A lot of things are being driven, like each sector. We talk about the GIC sectors that make up the index. Now, that's energy, communication services, financials, consumer staples, industrials, materials, utilities, healthcare, consumer discretionary, information technology, and real estate. The leader of total shareholder yield by sector, by no surprise, has been energy, with 6.8% total yield by sector. The bulk of it in buyback yield. As ESG concerns and less accommodating kind of global initiatives to be off oil, balance sheets of energy companies remain very robust, and the lack of investment going into the ground with unaccommodating kind of policies, at state by state and federal level, have muted kind of expansion and growth. So, total shareholder yield by sector is, how we measure it is the last 12 months dividends and buybacks minus issuance of new shares and divided by market cap. So energy, a clear leader in that space, by almost double of any other sectors. The call it the infant in the room would be real estate, continuing to really struggle. Dividend yield is high. They're typically structured as businesses that distribute cash to investors, but we're seeing a lot of issuance as companies are trying to shore up their balance sheet. Value versus growth. I've mentioned to you over the last couple of months, we made a bit of a tilt from, the index has been dominated by growth. It's very tech heavy. We've discussed the concentration of the top 10 companies in the S&P 500 and wanting to take a little bit of a breather for that. But during different phases of the economic cycle, where value outperforms growth, we seemingly, when we look at relative forward PE value versus growth all the way back to 1997 to today, and conflate interest rates on top of them. It's how does value and growth perform in different interest rate environments. Clearly growth does much better in a low interest rate environment. Money's cheap to borrow, and accelerated growth companies, the net present value of their future earnings is discounted by the implied interest rate. Now that was a mouthful, and I apologize, but I guess to impress upon you, I know what I'm talking about. That's why technology does well when interest rates are low, because these companies are generally have huge hockey sticks of growth in front of them, and the net present value of these long-tailed earnings, retain a lot more value when interest rates are low. But the market's really kind of setting itself up where value is cheap and growth is expensive, and so we've tilted portfolios as such, and by default have really taken a lot of steam or air out of the portfolios as investors and markets become concerned over perhaps very kind of heated market returns thus far. So another thing is we've talked about the breadth or the index concentration of valuation and earnings, and talking about the top 10 stocks in the S&P 500 and their PE ratios. It's 30.5 times. They're very expensive. Now these are high growth companies. They've become very big, so it's about 150% above the average. On average, the top 10 stocks in the S&P 500 usually have had an S&P, or pardon me, a price to earnings ratio around 20 times. It's sitting at over 30. Now the remaining stocks are much cheaper. They're trading at 18 times. So that's such an interesting, just taking 10 companies out of the S&P 500, and you can see a market that's only trading at 18 times. Now, to be more of a stock selector, it's very easy to become a value investor. You just avoid the kind of the nonsense. But nonsense has made a lot of money. Now, the weight of the top 10 stocks in the S&P 500 as a percentage of market capitalization has come down a little bit, but it's still sitting sky high at 35.8%. So listen, the economic concentration is something that we look at as well. It's a percentage of the S&P, like where's the money being spent? 41, this is the top 10 companies, okay? 41% of all revenue that's generated is turned back into R&D. 26% of it's free cash flow, 24% is operating income, 18% is capex, 13% is sales, and 11% is employee. These big companies that are growing so fast are investing in their growth. Billions and billions and billions of dollars of growth is being plowed back into these companies. So this isn't just air. Everyone wanted to try to kind of point 2 years ago to the dot-com bubble, the tech bubble, and say like we're headed there again. The difference is everyone was just euphoric about the advent of the internet. This time, these companies have been around a long time. They're economic beasts. They have recurring revenue streams, and they're investing significantly in their growth. So I'm not anti-tech at all. Now we have taken a bit of not a cautious tilt, but we've dialed back our exposure a little bit. So looking at the depth and breadth of the market is something we've talked about ad nauseum throughout the year, is how the Magnificent Seven performance and earnings dynamic versus the rest of the market. Now, looking through how the S&P, excluding the Magnificent Seven, has performed over the last 4 years, very different scenario. I can tell you year to date, the S&P 500 is up 21%. If you didn't own the Magnificent Seven, you're up 11. So if you just owned the Magnificent Seven, you're up 35%. Now that seems like, oh, Chad, I wish we should have just put all our money in tech. The person will remain nameless for a million reasons that I can't talk about certain clients. But years and years and years ago, I had a client, probably kind of 21, just become frustrated because, the broadly diversified defensible portfolio is inching along. But Tesla and some of the high flying stocks continue to go up and up and up. And this person made the decision to take their portfolio and concentrate it into 4 technology stocks. I can tell you what happened after, and I don't think you have to be a genius to figure that out. But in 2022, if you owned the Magnificent Seven, you were down 40%. So, the share of returns continues to be dominated by the Magnificent Seven, but a lot of the earnings growth has been shown there as well. The earnings growth has been dominated. The market has rewarded these companies. Yes, euphoria and confirmation biases come into play all the time when trades are working well. But when I look at earnings growth pro forma year over year, the Magnificent Seven far stands above the S&P 500, excluding those names, by a wide margin. For instance, in Q1 of 2024, the Magnificent Seven showed 50% earnings growth, whereas the broader market, or the 493 stocks, had negative growth of 2%. In Q2 of this year, the Magnificent Seven put up 35% earnings per share growth. The rest of the market eked out 6. Q3, the Magnificent Seven eked out 20% earnings per share growth, whereas the S&P 493 was flat. Now we've seen the broadening of the market, though, starting to happen in the fourth quarter of fiscal 2024. We're seeing an estimate 21% earnings per share growth for the Magnificent Seven, and the broader market surging up to 13. So we're seeing profit margins and quarterly sales trend in the right direction, and that thematic that the market is going to be broader and thicker and deeper remains true. Now, interestingly enough, just going from a growth tilt to a value tilt, and when clients say I'm worried about the market seems expensive. Well, if you're in growth, you're paying about 28.5% earnings for your portfolio of stocks. If you tilt to a value style, you're instantly in a more cautious 16.7 times. So size, small, mid, large, and style, value, blend, and growth. And across all things, and that's just on a size of company and style. Overlay that 9 squared matrix 3x3 across another 11 GIC sectors. There's a host of opportunities to make and lose money. Now, we always talk about the S&P annual returns and intra-year declines. On average, despite average intra-year drops of 14.2%, annual returns have been positive in the last 33 of 44 years. We talked about this earlier in the year. It is normal to have an intra-year pullback of at least 10%. Like, it's clockwork, not every time, or else everyone would trade it. But we did have an 8% pullback earlier in the year. So this is very normal. We did say that we would expect the markets to be a little choppy into the end of the year, and then that's playing true. What drives the economy? Well, global economy is consumer-led, so we always have to look at the consumer balance sheet. As an aggregate, in the U.S. alone, the consumer balance sheet, this is in trillions of dollars, by the way. There's $184 trillion of assets. Homes make up 28%. Other tangibles make up 5%, deposits make up 8%, pension funds make up 17%, and other financial assets make up 42%. Now, from a liability standpoint, these are other non-revolving, revolving lines of credit, auto loans, liabilities, student debts. Total indebtedness only sits at 20 trillion. There is assets out there. Now, household debt service ratio has creeped up a little bit. Obviously, interest rates have been higher, but way down from what we saw, in 2009. This number, the debt payments as a percentage of personal income, sits around 10%. So still well below the average. Interestingly enough, flows into early delinquencies, and this is what percentages of loans are starting to poke their heads into past due 30 days. Student loans disappeared. Well, it's because the Biden administration basically forgave, bazillions of student loans. So that's off the market. So that's great for the economy. But we've seen auto loans start to creep up. The auto sector is under pressure right now, and we're seeing credit card debt start to climb. Not even seasonally, but just starting to watch it a little bit. But the consumer remains robust. Unemployment and wages, civilian unemployment rate and year-over-year wage growth. And this is why we're starting to see interest rates come down, is because unemployment rate sits at 6.2, well below an average of 6. And the wage growth is been strong at 3.9%. So the confluence of those two factors makes for a robust economy. Inflation is down. Obviously, headline CPI is something everyone's been talking about. Some people are talking core inflation, food inflation, energy inflation, headline deflators, like any politician, depending on what side of the political aisle they want to. But overall, as a basket, excuse me, inflation has come down. And so again, that back to that thematic and a quick little interlude here is those thematics remain robust. We're constructive on a synchronized global economy. We're constructive on, I think, over 10 or 11 trillion dollars of deposits on the sidelines in cash that will be actively redeployed as the Fed continues to bring down interest rates and investors seek real return on their money. And the proliferation of more efficiencies and profitability through the advent of artificial intelligence throughout the broader world as an efficiency tool. We talked oil markets. We've seen a lot of volatility. It's a nascent topic near and dear to many of our investors as we're domiciled on the west side of the country here. But changes in production and consumptions of liquid fuels, like we saw the price of crude, WTI nominal prices of USD, they peaked they shot up to 123 a barrel on March 8th of 2022, and now they're sitting kind of at September 30th around 68. I don't have commodity, yeah, $68 at the end of the month, and already looking at another screen here, we've got headline oil at 73.89. So we've seen a almost 10% move in oil in the first part of this month, obviously, with conflict in the Middle East starting to surge again with Iran and Israel accelerating their conflict. But from a U.S. perspective, we are seeing inventories come down. Okay, it is a strategic reserve. That's not a great thing. Energy independence and all of that. And we're seeing active rigs start to trend down as well. Obviously, there's some seasonality to it, but year over year, we're starting to see a little bit of a tapering off again from poorly accommodating political regimes and ESG concerns around drilling in more sensitive areas. So we're not running out there and drilling baby drill quite yet. So we expect tight oil markets for a while, and we are constructive. High yield bonds. High yield bonds are kind of the would be an interesting analogy. I'm generally pretty good on the fly, and I'm a great storyteller, but they're kind of the cough before the flu, if that makes sense. Is that we look at default rates and spread to worst as kind of like that, not so much as a leading indicator, but a canary in the coal mine. The bond market is much bigger than the equity market, and the bond market tends to be a little faster, a little bit less more pragmatic and less euphoric in and around it. It just comes down to math and numbers and coverage ratios. But default rates on average, the long run average on a high yield bond is around 3.51%. So that means 3.51% of bonds default and go belly up. As of September 30th, 2024, default rates are sitting around 1.78. So we're not seeing defaults. So high yield markets remain humming along. As such, because we're not seeing that, the spread to worst or the spread above their comparable non-high yield counterparties is a little tighter. People are paying more. There's not as much risk in the market. But that being said, when things do blow up, they're blowing up bad. Recovery rates are down. And that's largely because when we look at where a lot of these loans are being made, the market has tilted more towards technology. And it's a little different when you loan money to, so long as pause you probably ever wanted a podcast, you thought it'd shut off. But an old world business that was long assets like bridges or buildings or physical assets, these are companies being lent to that have technologies and software. So when they go bad, there's really not as much tangible recovery. Global equity markets, and this is what I talked about at the front part of this this conversation, was why I keep hammering home, and I'm not really talking much about Canada. And I used to always reference that the U.S. economy was, 52% or 53% of global GDP, and so as such, we really key off to our neighbors to the south to be our, our guiding kind of bellwether, North Star as to what's happening in the world. But it's actually the share of global market capitalization as a percentage weight in all the MSCI All Country World Index is the U.S. now makes up 64% of the MSCI All Country World Index. The U.S. runs the show. We just live in it. Canada is real small, guys. So revenue exposure versus country of listing, we're seeing obviously a very big tilt there. The Europe ex of the UK only makes up 11% of the world. The emerging markets makes up 10, and Japan makes up a piddly 5, and Canada's even smaller. I think it's around 2.1. Don't quote me on that one. Okay, guys, here's the kind of the piece de la resistance. All-time highs. Had a conversation with a great friend of mine, 5 minutes before I started recording this, as pushing them towards deploying more capital. Was well, we're waiting for this pullback. Well, people have been waiting for a pullback for, I don't know, 100 years. The markets continue to make new highs. Time in the market far exceeds timing the market. Now, not to be coy with it, there's nothing worse than deploying fresh capital, fresh juicy liquidity, and then get spanked with a sharp correction. You feel stupid. That being said, what happens when you invest at the all-time high? So this is all-time highs and market flows. S&P price daily index from 1950 to today. Now, the number of all-time highs, or ATHs, that we saw in 2024 alone was 43 times the market hit an all-time high. Think about that. Now, the percentage of days that the S&P closes at an all-time high, 6.6% of the time, the market's at an all-time high, and every day, okay? Now, percentage of all-time highs that act as the market floor, meaning like that the market just keeps going, 30% of the time. Now, the average cumulative S&P 500 total returns, and if everyone can either get a notepad or slow down my voice here, and I'll go real slow. So this is from 1988 daily to today. Investing on any day, what your returns would be 3 months out, 2.9%. Okay, great. Now investing at a new high, going, hey, Chad, I don't really want to invest. We're at an all-time high, but I push you to do it anyway. 3 months out, you're up 2.3% if you had taken my advice to buy the high every time. So it's less than if you just didn't listen to me. Stretch out, and this is really, really interesting. I want to talk 2 years, 3 years, and 5 years. Investing at the new high has outperformed investing on any day. Think about that. Now, if you invest at the all-time high every time, 2 years out, over 300 basis points. This is a 28.9% return to a 25. Over a 5-year period, you'd outperform significantly. So what I'm saying is it's not a strategy that you should go out and look for the all-time high. But what I'm telling you is that it's okay if the market's at an all-time high. If the underlying economic cycle is constructive, like the Fed is accommodating with easing fiscal policy, and we see global synchronized recovery, we see healthy jobs, we see a ton of liquidity on the side, who cares if the market's pretty smart. The market wouldn't be at an all-time low if things didn't look good going forward. So don't get in your head too much. I think that was a pretty long one. I don't want to kill time for the sake of time. As again, is an absolute pleasure, and it is my gift and calling in this world to have a great team that surrounds me. I love what I do. If any of you have any questions or comments or feedback that you'd like to give, feel free to reach out to myself or any member of the team. We're here at your disposal. If you're a client, thank you. If you're not and you're interested, give us a call. We'll see if there's a fit. But have a wonderful month, and I look forward to speaking with you guys next month. Take care.